All right, pause for a second because something just snapped in the silver market. Last week alone, silver dropped from about $121 down to $72 in a matter of days, nearly 40% gone. And now, almost just as fast, it's back near 90. But here's the part that should stop your scroll. This isn't traders doing this. This is governments. Today, the US is hosting a 50-nation critical minerals ministerial, and at the same time, Donald Trump is pushing a $12 billion strategic minerals stockpile modeled after the Strategic Petroleum Reserve. Both sides just confirmed the same thing without saying it out loud. Silver is being treated as a strategic asset right now. Stay with me because I'm going to show you why this window matters immediately and how you can spot this setup before the crowd next time. Before I explain what caused this move, let me teach you something most people don't really understand about commodities. Price is not the same thing as supply. The screen price you see is mostly a paper price, driven by futures contracts, leverage, and margin rules. Physical supply is a totally different world. Think of it like airline tickets. The price online can crash because of an algorithm, but if every seat is booked, you're still not getting on the plane. Silver works the same way. Futures traders can dump contracts and smash price, but manufacturers and governments care about one thing. Can they get metal when they need it? And right now, they're acting like the answer might be no. Here's why this matters to you specifically. If you're watching this and you've been stacking silver or you've been thinking about it, you need to understand that what you saw last week wasn't weakness. It was mechanical stress in the market structure itself. And that stress creates opportunity for people who know what they're looking at. When you see a 40% drop in days, followed by a 25% bounce in hours, that's not normal commodity behavior. That's the signature of a market where two different groups are playing two completely different games. One group is trading contracts, the other group is trying to lock down physical metal. And when those two worlds collide, the repricing can be violent. So what does that tell us? It tells us that the screen price and the real cost of acquiring metal have started to separate. And historically, when that gap opens wide enough, it doesn't close gently, it snaps back hard. If this is making sense to you so far, drop a comment below and let me know what you're seeing in your local market. Are premiums up where you are? Are dealers running low on inventory? That ground level data matters more than you think. Now here's what's actually happening under the hood. Let me break down the sequence, step by step, because this isn't random chaos. First, you had an engineered liquidation last week. Margins rose, leverage unwound, and forced selling hit the futures market. When that happens, price doesn't drift down. It falls through trapdoors. That's how you go from 121 to 72 so fast. When margin requirements increase on futures contracts, traders who are using leverage get margin calls. They have to either post more cash or close their positions. And when everyone's getting squeezed at once, there's no orderly exit. It's a stampede for the door. Sell buttons get hammered. Stop losses trigger other stop losses. The price just collapses under its own weight. Second, while that paper selling was happening, physical demand didn't blink. In fact, it quietly increased. Governments started talking stockpiles, manufacturers locked in forward supply, and Shanghai kept paying a $14 to $15 premium over Western prices. That premium is the tell. It's the market saying paper's cheap, metal's not. See, in China, they don't just trade contracts. They need actual silver for solar panels, for electronics, for industrial production. When they're willing to pay $15 more per ounce than London or New York pricing, that's not speculation. That's desperation for physical delivery. So when the liquidation ended, price didn't stay down. It rebounded more than 20% almost immediately, back toward 90. And here's what's wild about this. The very selling that crushed silver created the conditions for a squeeze later, because it scared paper players out while pulling real buyers in. Think about what happened. Weak hands, people trading on margin, people who were long just for a quick trade, they all got flushed out when price cratered. They sold at 70, 75, 80. They're gone now. But the people buying at those levels? Different breed entirely. They're buying physical. They're thinking long term. They're not worried about next week's price. They're worried about next year's availability. Now let me show you what most people are missing. Governments don't announce stockpiles to trade price. They do it because availability is at risk. And once availability becomes the concern, price tends to reprice violently, not gradually. Think about the logic here. The United States government doesn't wake up one day and say, hey, let's spend $12 billion on a strategic mineral reserve just for fun. They do it because their analysts are telling them there's a supply problem coming. Maybe it's geopolitical, maybe it's production, maybe it's demand from green energy. Doesn't matter. What matters is they've done the math, and the math says we need metal secured now. And it's not just the US. You've got 50 nations meeting right now to discuss critical minerals. 50. That's not a conference, that's a scramble. When you see coordinated international focus like this, it means the problem's already here. They're not planning for some distant future scenario. They're responding to current stress in the supply chain. And here's the thing about government buying. Once they start, they don't stop because price went up 10%. They have mandates. They have strategic needs. Price becomes secondary to acquisition. But here's the part that should make you pay attention even more. This isn't happening in isolation. You've got the futures liquidation creating paper weakness. You've got physical premiums screaming the opposite message. You've got government stockpile announcements signaling long-term concern. And you've got manufacturing demand that's structural, not cyclical. Solar panel production alone is consuming more silver than most people realize. Electric vehicles use more silver than traditional cars. 5G infrastructure, it all needs silver. That demand isn't going away if there's a recession. It might slow, but the secular trend is locked in. So you've got this perfect setup where short-term technical selling met long-term fundamental buying. And the bounce you're seeing right now, that's not retail FOMO. That's the market repricing the disconnect between what futures traders thought silver was worth and what physical buyers are actually willing to pay. When Shanghai is paying 90 plus and New York's trading at 75, somebody's wrong. The market doesn't allow those gaps to persist. Arbitrage forces step in, or buyers flood the cheaper market, and the price converges. We're watching that convergence happen in real time. Now, here's what very few people are talking about. The liquidation last week might have actually reduced available supply for future delivery. How? Because when prices crash, miners don't ramp up production. They cut it. Marginal mines shut down. Development projects get delayed. And it takes months, sometimes years, to bring that production back online. So you get this perverse outcome where a price crash today creates a supply shortage tomorrow. And if physical demand stayed strong during the crash, which it did, you've set up a squeeze scenario where there's less metal coming to market, just as more buyers are trying to lock in supply. This is the exact same playbook we've seen before. Go back to 2011. Silver didn't just grind higher. It whipped around violently, flushed weak hands, then exploded when physical demand overwhelmed paper supply. In early 2011, silver was trading around $30. By late April, it hit nearly $50. But the path wasn't smooth. There were multiple 10 to 15% pullbacks along the way. Each pullback shook out the tourists, the people who were just along for the ride. And each time the metal came back stronger because the physical buyers kept showing up. They didn't care about the daily chart. They cared about securing ounces. Or look at March 2020. During the panic, silver collapsed as everything was sold for cash. It dropped from $18 to $12 in a matter of weeks. Everything was being liquidated. Stocks, bonds, commodities, crypto didn't matter. Everyone needed dollars. But physical premiums blew out. Mints ran dry. You couldn't buy silver eagles without paying $5, $6, $7 over spot. Some dealers stopped taking orders entirely because they couldn't source metal. And within months, price had doubled. By August 2020, silver was back over 28. The people who bought physical in March made a fortune. The people who only watched the screen price thought silver was dead. Every time this setup appears, you see the same pattern. Paper volatility first, physical stress underneath. Then a sharp repricing once the disconnect can't hold anymore. It's like a spring getting compressed. The more the paper price diverges from physical reality, the more energy builds in the system. And when it releases, it doesn't ease out slowly. It snaps. You get moves that seem irrational on the chart, but make perfect sense when you understand the mechanics behind them. The chart is just showing you the outcome. The real story is happening in delivery queues, in premium structures, in who's buying and who's selling. Zoom out, and you see it clearly. When institutions start worrying about access instead of price, the market's character changes. It stops being a trading vehicle and becomes a strategic asset. And strategic assets don't trade like commodities. They trade like scarce resources. The price becomes a function of availability, not just supply and demand in the traditional sense. It's supply, and who controls it, and who needs it, and who can get it when they need it. That's a different calculation entirely. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this fail? Absolutely. Paper markets can stay irrational longer than you expect. Futures leverage can still push price around, and a strong dollar or macro shock could slow things down. If the Fed pivots hawkish again, if the dollar rips higher, if there's a credit event that forces more liquidation, silver could get hit again. That's real risk. You have to acknowledge it. And not every government headline turns into immediate buying. Sometimes these announcements are political theater. Sometimes they're floated to test markets or signal intent without follow-through. We've seen it before. So you can't just read a headline and assume it's done deal buying pressure tomorrow. You have to watch for confirmation. Are there actual purchase orders? Are stockpiles actually growing? Are there budget allocations backing up the rhetoric? Those are the questions that matter. Could this be manipulation? Maybe. Could large players be engineering these moves to shake out weak hands and accumulate cheaper? It's possible. Markets aren't always fair. But here's the thing. It doesn't actually matter whether there's intent behind the scenes. The mechanics are what matter. Focus on what you can control and what you can measure. Premiums, rebounds after liquidations, who's buying when price drops. Those signals matter more than narratives about manipulation or conspiracy. You can't prove intent. You can measure outcomes. So measure what you can see and trade what you can verify. There are probably 3 types of people watching this right now. First, you're already bullish on silver, and you're asking if this is finally the move. I get it. You've been watching this market for months, maybe years. You've seen false breakouts before. You've been burned by buying the hype. You want to know if this time is different. My advice is simple. Don't chase strength blindly. Watch structure. If 88 to 90 holds midweek, that's information. If price consolidates there without heavy selling, if it builds a base, that tells you buyers are still present at these levels. That's constructive. But if it fails back below 85 fast, you know the bounce was just short covering, not real demand. Let the market show you what it wants to do. Don't project what you want it to do onto the chart. Second, you're skeptical. You think this is hype, or another false breakout, or YouTubers pumping their bags. That's fair. I respect that. For you, ignore the headlines and watch Shanghai premiums and physical availability. If those stay elevated, skepticism gets expensive. You don't have to be a believer to be a realist. If the data keeps pointing to physical stress, at some point you have to adjust your view. You don't have to go all in, but you can't ignore persistent signals just because you don't like the narrative around them. The market doesn't care about your bias. It cares about supply and demand. So watch the premium data. Watch delivery times. Watch inventory at the COMEX and the LBMA. If those keep flashing warning signs, your skepticism needs to evolve into strategy. Third, you're newer, and you're trying to understand how to use this later. This is the key lesson for you. When price collapses fast, but physical signals stay tight, that's not weakness. That's stress. Different players, different incentives. The paper market is traders managing risk and leverage. The physical market is end users securing supply. When they diverge, pay attention. That divergence is information. It's telling you the market is dislocated. And dislocations create opportunity for people who know what they're looking at. Your job isn't to predict the exact top or bottom. Your job is to recognize when the market structure is under stress and position accordingly. The universal principle here is this. Markets reprice when paper and reality collide. It doesn't happen on a schedule. It doesn't happen cleanly. But it happens. And when it does, the people who understood the setup beforehand are the ones who profit. The people who were just watching headlines get caught off guard. So here's what I want you to answer in the comments. What are you watching personally to confirm or deny this thesis? Are you tracking premiums? Are you watching COMEX inventory? Are you monitoring production data? Let me know, because I want to know what signals you're paying attention to. So here's where I stand. I'm not predicting a guaranteed 100 by Friday, and I'm not dismissing the risk either. I'm watching 3 things closely. First, I'm watching whether silver can hold that 88 to 90 zone without heavy selling. If it consolidates there, if it trades sideways for a few days and doesn't collapse, that would tell me buyers are defending that level. That's a structural tell. It means there's real demand, not just short covering. If it breaks down fast, well, then the bounce was technical, and we're back to broader range trading. Second, I'm watching whether 95 to 100 acts as a true breakout area into the end of the week. That's where you've got previous resistance, where you've got psychological levels, where a lot of traders are going to either take profit or add to positions. If silver can push through there and hold, that opens up a run to 110, 115, maybe higher, but it has to clear it convincingly. A spike above 100 that immediately reverses isn't a breakout. It's a trap. So I need to see acceptance above those levels, not just a probe. Third, I'm monitoring whether physical premiums, especially in Asia, stay elevated. If Shanghai keeps paying $14 to $15 over London pricing, that's confirmation the physical tightness is real. If those premiums compress back to normal levels, it means the supply concerns were overblown or short-term. Premiums are the truth teller in commodity markets. They cut through the noise. They tell you what people are actually willing to pay for metal in hand versus contracts on a screen. So I'm watching them daily. Based on my analysis, this move wasn't emotional. It was mechanical. The fundamentals didn't break last week. They actually validated. You had a margin-driven liquidation that cleared out weak positioning, and you had physical buyers step in to absorb supply at lower levels. That's healthy market function, even though it feels violent. The fact that government stockpile discussions are happening right now, the fact that a 50-nation summit on critical minerals is taking place, the fact that Trump is pushing a $12 billion reserve, all of that lines up with a market under structural stress. This isn't one data point. This is a pattern. If history rhymes and silver breaks above 100 cleanly, the move that follows could be fast and large. I'm not making a specific prediction, but I will say this. When physical premiums are elevated, when government buying enters the picture, when industrial demand is structural, and when technical liquidations have cleared weak hands, you've got the ingredients for a repricing event. Not a gradual grind, a repricing, where the market says, okay, we were wrong about value, and we need to adjust fast. That's what happens when paper meets reality, and reality wins. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the premium data yourself. Look at the COMEX inventory numbers. Read the government announcements. Don't take my word for it. Don't take anyone's word for it. Build your own conviction based on your own analysis. That's how you develop the skill to spot these setups before the crowd next time. You learn to recognize the patterns. You learn to ignore the noise and focus on the signals that matter. And over time, you get better at reading market structure instead of just reacting to headlines. If you made it this far, you're part of a small group that's actually trying to understand markets instead of just reacting to them. That mentality will serve you well. Most people won't sit through a detailed breakdown. They want the headline. They want the hot take. You're different. You're here because you want to learn how to see these moves coming. Keep that mindset. Keep asking questions. Keep verifying data. That's what separates people who get lucky once from people who consistently recognize opportunity. If this breakdown helped you see something you weren't seeing before, do me a favor. Share this with someone who needs to hear it. Hit the subscribe button if you want more deep dives like this. And drop a comment with what you're watching, because I read those and they help me understand what matters most to you. The more we share data and observations, the better we all get at reading these markets. That's the goal here. Not hype, not predictions, education and pattern recognition. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.